My name is Todd Dills. I'm the editor of Overdrive magazine, and you're here today for our annual Partners in Business seminar session. This year we're focused on, like a big theme this year at the show, of surviving the down market and thriving on the other side. And we're going to get into a lot of income, revenue, cost, performance data of ATBS clients with Mr. Mike Hosted. He's a VP there, and their ATBS is the main partner of Overdrive in the Partners in Business program, has been for 20 years. We've got a brand new book. If you got the postcard that we handed out to you coming out on the backside, there's a QR code and likewise a link where you can download that. It's free of charge. Brand new updates for the 2024 edition. A lot of it centered on it's across the board, really, from anything from more red flags to look for with double brokers that we've been a lot of independents have been dealing with over the last couple of years in a big way, and insurance information, various other things you can take home, contemplate, bone up on the fundamentals. It's always a good thing. A bit of a refresher every year we do this. But before we get into the main part of the presentation, I want to take a moment to recognize our Trucker of the Year. Overdrive's been doing this Trucker of the Year program for many years. We rebooted it last year in a somewhat of a different format. We had Truckers of the Month throughout the year through October. There were 10 of them. They were all semifinalists. We narrowed that to 3 main finalists. They're all owner-operators. Eligibility to be a part of the program, to be nominated, you have to have no more than 3 trucks, have been operating for at least 4 consecutive years. And we go through operational data, income data, a lot of testimonials, a lot of references, a lot of interviews. We do a story about each of the owner-operators, the Truckers of the Month. And at the end of the year, we came out with a winner. And I want to bring up Jay Hosty. You guys probably heard about this already. We've already announced it. Come on up, Jay. Jay Hosty is from Diamond Head, Mississippi. He's leased a Landstar, has been for about 20 years, but his history goes back 4 decades. Jay, how you doing, my man? He really stood out from the pack in terms of focus on keeping costs low and keeping more of the revenue to himself. And he really outperformed a lot of the competition. I think he's looking up at the display because he hasn't seen what is our trophy, which I'm going to give to him now. Yeah, we worked with a gentleman named Eston Hoffman in Pennsylvania to build what is a custom replica of Jay's 2006 Western Star 4900EX. Anyway, turned out pretty well. And Jay, do you have anything to say any wisdom you want to impart to the owner-operators here?
Well, it's a tough road if you're an owner-operator. I know you know that. First off, I give all my glory to my Lord and Savior, Jesus Christ. Without him, I am nothing. And basically, if you're onymer-operator, it's for me, it's just about knowing your cost, knowing, it costs money to run a truck, and you got to know where you're at. You can't just fly by the seat of your pants. So that's about what I could say about that.
Hey, we got a little surprise for you too. This year, the Trucker of the Year program is sponsored by Commercial Vehicle Group and their Bostrom Seating brand. And Rick Gregg, my colleague over here, over Randall Riley in Fusible, is gonna got a little something for you, my man.
Go.
It's check worth a free Bostrom seat. Probably go nicely in a brand new Western Star. I know that Jay is putting a big sleeper on right now, so I'd encourage everybody to read Jay's story. If you go to overdriveonline.com, our Trucker of the Year section, several pieces that we did about him over the course of the last year.
Nice.
Let's give him a big round of applause again, Jay. Thank you, my friend. And with that, I want to get us to the beginning of the presentation. So, Partners in Business, long-running, like I said, this year is sponsored by the Rush Truck Centers dealer group. And they offered a little bit of a message that I'm just going to read to you to start the program. So more than a dealer network, Rush Truck Centers is the premier solutions provider for the commercial vehicle industry. More than 140 Rush Truck Center locations across the U.S. No one can match their network reach and scale. Rush Truck Centers has partnered with Overdrive parent company Randall Riley for many years across many channels, and they're excited to come together for Overdrive's Partners in Business for 2024. If you missed yesterday's announcement, Rush Truck Centers is also proud to partner with Wounded Warrior Project to honor and empower America's injured veterans. By joining them in an important effort, you can enter for the chance to win an iconic piece of trucking history. Now through September 15, 2024, visit winthelast389.com, where you can make a donation to Wounded Warrior and enter special sweepstakes to win the last Peterbilt Model 389 ever produced. The sweepstakes pays tribute to the legacy of the model, giving the winner an iconic piece of the Peterbilt story. The Model 389X turns heads, captures hearts, as it truly embodies the rich history of trucking with its traditional styling and stunning display of chrome and class. It's a good-looking truck for sure. Stop by the booth. It's number 36220 to see it. It's on display there, and you can learn more about the sweepstakes. As noted, visit winthelast389.com by September 15th later this year to make a donation and enter for the chance to win. And with that, I'm going to turn it over to Mike Hosted and Gary Buchs.
Well, thank you, everybody, for joining today. I want to start by, again, congratulating Jay. That's an awesome honor, and what a cool gift. So congratulations. That's really great. Anyway, we'll get started. We've got a lot to cover. I know that we're a little bit behind, but Gary and I have been doing this a few years together, and it's an honor to be here with you again, Gary, and we're looking forward to the discussion. We do have a couple of spots blocked off for questions that you might all have. We'll also hang out back afterwards if you have additional questions or just need more insight on anything that we're talking about today. So we're going to go over a lot of data, what's going on in the industry. We're going to talk about, what you can do to survive, what you can do to make more money, and
how to turn this around and become a thriving owner. And if you're new or looking into it, how to avoid some of the pitfalls. When you get started right, don't try to catch up 6 months later. That's a big key.
That's right.
Yeah.
So let's get started. We always like to start off, and thanks for anybody that's back again this year, but we always like to start off by talking about the economic environment of trucking. So what's going on? And I mean, I don't have to tell you guys, it's tough. It's really tough. But we're going to look at some data. We're going to look at what's actually going on with numbers, what's going on with rates and things like that to get started, just to kind of set the table and see what we need to do to survive. So I like to start off looking at the spot market. The spot market is really a good indicator of how healthy the trucking market really is, because it's spillover freight generally. There's contract freight that's with carriers, and then they put it into their brokerage if they can't haul it, and then if the brokerage can't sell it to their trusted fleets, they put it in the spot market generally. And so it's a really good indicator of how much excess freight there is in the marketplace. And so anytime there's excess freight, rates tend to go up. It's very simple supply and demand. And so this is a really good indicator. This is from truckstop.com, and this is the load to truck ratio over time. And so if you look back through time on the left here, we have the number of loads per one truck looking for a load in the spot marketplace. And so over time, you can see it really does mirror a good market time. So you can see here in 2018, we had great freight. We had about 75 loads per one truck looking for a load in the spot market. And because of that, rates after fuel surcharge went up to $242 back in 2018. And then we kind of just had a tough year in 2019 and early 2020 when the pandemic started. So the amount of freight went down. We were about 30 loads per truck. And rates went down in the pandemic all the way to $1.54 after we back out the cost of fuel. So that was an extremely difficult time in the spot market and low freight rates. Then the freight boom hit because of the pandemic, right? Everybody had to buy goods. They couldn't go on trips. They couldn't go out to restaurants. So they were buying goods. They were buying Peloton bikes. They were buying new TVs, things like that. So freight went through the roof. And we had an awesome period for over 2 years where rates, we had almost 240 loads per one truck looking for a load in the spot market. That's how much freight there was. And that caused rates to balloon up to $274. Fast forward to 2022, you name a number of factors, the war in Ukraine, inflation, people started going out to restaurants, things like that again, and freight fell off a cliff, especially in the spot market. We went down to about 60 loads per one truck looking for a load, but most importantly, rates went down to $1.86.
So I'd like to add in here as an owner-operator, what do you do with this data and how do you make it work for you? Try to find out the regions you run in and the truck to load ratios for where you run. And it varies greatly. You know, you who have experience, if you go to Montana, you know, the rate, there aren't many loads per truck. It can almost be, it'll be negative. And, but if you're in Chicago, Indianapolis, and so on, so when you start designing your plans or start planning ahead, keep it aware and find the data. It's out here, and if you need help with that, just start asking, where can we get this? Overdrive, we have that information available at times, so.
For sure. So what's interesting about this data point is we're now at about, I believe this week we're at 71 loads. So we're going up. We're starting to see more freight get into that spot market. We are hovering right at about $1.88. But what's really interesting is that we're about 30 to 35 cents higher on the floor now than we were prior to the pandemic. And that's because of inflationary costs, right? We can't possibly run for $1.54 and survive. So we have set a new floor, but that's because costs have gone up and we need that new floor in order to survive. So that's the spot market, and again, that's a really, really good indicator of what's going on. So this is the Cass Freight Index. So this is major shippers, major carriers. This is contract freight that we see out there. And so this is volume. This is the amount of shipments moving. And if we look over time, again, when volumes go up, like in 2018, rates went up accordingly. The volumes went down in 2019, 2020, and then we had a huge volume increase there in 2021. So we have had volume go down over the last year, and it's really impacted rates, and you all have felt it. So volume's important, but let's look at rates themselves. And so again, rates go up when there's more freight to haul than what we can haul. So in 2018 that happened, then we saw the pandemic hit, 2019 pandemic, and then we just shot through the roof in terms of rates. We've never seen rates go up that high, and especially for that long of a period of time. And then again, in 2022, things kind of fell backwards, and then especially in 2023. But again, if you look at that black line up there, we've set a new floor. So rates are about 35 cents higher than they were prior to the pandemic. And it seems like we're just kind of bouncing on the bottom now, where most people think rates aren't going to go down any lower, but they're not going to go up quickly anytime soon. So we have to sustain.
So again, as an owner, what do you do with this? And one of the mental challenges is what we call anchor pricing. You know, what do you think a load should pay? You've got a history, and you have a history of both what it pays and what your costs are. And you have to be very careful that these anchor prices, what you think things should be, don't dominate everything you're going to do. You have to be more flexible in calculating and knowing real-time numbers.
Exactly. So I've never shown this one before, but this one's really interesting. And so this one came from the folks at DAT, and the red line mirrors the spot rate, while the blue line mirrors the contract rate. And so what's interesting is anytime that red line has a nice increase and approaches that blue line, we're in for a good trucking market. The spot rates have moved up. That means there's excess freight, and rates are probably going to go up accordingly. And so you can see it over time. Again, in 2017, it climbed up, and then in 2018, we had a great year. In 2020, it climbed up, and we had a great 2 years, and we sustained it. But what's good news, and there is some good news out there, is that we are on an upward trajectory again for the first time in 2 years. And so while we're not in a good market right now, and while we don't know exactly when it's going to hit, it's a really good leading indicator that things probably are going to start to turn around, while slowly, at the end of Q2 or probably in Q3 is what most economists are telling us.
Yeah, I see with the election year, I can see potentially some stimulus coming out of the federal government, some new budget items that are going to push some services and products and things. They'll push it out through companies, through stimulus, not to the degree, I don't believe, that we had during the pandemic. But I do think politicians know we vote with our wallet. They want people to feel good going into the election. No matter what party, they want to get reelected. So I can kind of foresee, in history-wise, that's a potential to keep your eyes on.
So at ATBS, we're fortunate enough to work with over 30,000 owner-operators a year. With that, we get to talk to a lot of major motor carriers out there as well. So you think about the Landstars, Swifts, JB Hunts, all the big carriers in the world we get to talk to on a regular basis to try to understand what's going on. And so we do a survey every fall to try to understand, are they going to grow? What are they thinking about the market? Things like that. And so just some quick summary points of the hundreds of fleets that responded to us. We seem to be bouncing on the bottom, waiting to go up. And that's pretty consistent. We keep hearing that over and over again, is that we're on the bottom. We've been there probably since, over a year. But we're just bouncing on the bottom, waiting for things to get better. Rates are going to remain flat until Q2 or Q3, and that's pretty consistent. We keep hearing that, again, from economists, from trucking companies, from pricing standpoints. Very consistent there. There's still excess capacity in the marketplace that needs to come out before rates come up, and that's really true, and I'm going to get to that here in a second. Something that's really interesting, though, is truck availability and prices are making the barrier to entry possible again. And so with the truck prices, especially used truck prices going down, it's a lot more affordable to get into the market now or expand your fleet than it's been in a very long time.
Yeah, one of the keys to that entry with a truck or purchasing a new or leasing a new truck, a different truck, is don't be afraid to negotiate harder. Interest rates are up, but I have an owner that I wrote a story about. It wasn't right in the spring. He saved $50,000 negotiating and got a lower interest rate because he had the courage to negotiate and set his terms with the dealer. And don't have the courage, be the boss, as I say. Take control of what will work for you. But know ahead of time, build your plan.
And then the last point here is that many of the asset-based fleets made COVID-era changes, and it's crushing them. So if you think about the big company driver fleets of the world, in the COVID era, they had to give huge pay increases to keep their driver population, to recruit, to do things of that nature. And because of that, they can't back pay up, right? But rates have collapsed. And so some of these big company driver fleets are really hurting right now because they gave these huge pay increases and it's not sustainable based on current rates. So kind of interesting to think about, but it's good to be an owner-operator because you can make changes quickly, whereas they take years and years to make these kind of changes.
Yes, exactly. You have the luxury of speed because you're in control. You don't have 500 people that you have to deal with.
So on our survey, we also asked last year, what happened? Did you grow? Did you shrink? What happened to your fleet? And so these are major owner-operator fleets. There's probably 100,000 owner-operators in this pool that we surveyed out of. And so in 2023, the average carrier lost about 16.5% of their independent contractors. That is a huge, huge number. We've never seen contraction like that. And the range was anywhere from down 40% to up 20%. And I'll tell you, the ones that were up 20%, they were like a 50-truck fleet that grew by 10 trucks, right? There was no major movement in terms of capacity growth. So when we asked about this year, are you going to grow your owner-operated population? Very modest numbers, only up 4%, which is pretty rare. Normally we see fleets wanting to grow 10 or so percent, but because of marketplace conditions, there's pretty modest expectations around growth in the owner-operator population.
Right. Part of that, I think, is they want to keep the contractors and the drivers they have now happy because some of them have lost freight availability or lanes, so they have to balance out that and try to keep the good people they have happy.
So this is a really interesting chart, and this came from the folks at DAT. This is the number of new motor carriers entering the marketplace over time. And so this is pretty important. If we look at a normal era, which is from the left until about 2/3 of the way over, we see a steady growth of the number of new entrants into the marketplace, generally around 2 to 4% growth in terms of new motor carriers. And that makes perfect sense. That's the growth of GDP. That's the growth of population. So we should always be adding new carriers. And if you see in a little bit of a down market, maybe in the middle there in 2019, we might lose capacity for a month or two, but not for a very sustained period because of population growth and GDP growth. But then in the COVID era, we had carriers entering the marketplace at a rate we've never seen before because rates were fantastic. Why wouldn't you go chase the good rates? But because of that, we added way too much capacity, and it's now hurting our rates. And so now we're seeing, on the right-hand side, we're seeing carriers leave the marketplace at a rate we've never seen before. So while that seems negative, if you're still an owner-operator, that's a good thing. We actually need capacity to leave the marketplace for rates to bounce back up. And so we're seeing it happen. this is probably a lag measure too, meaning we're probably going to see this down for another year, because when you lose your authority or when you go out of business, you don't like send FMCSA an email and say, hey, I gave up, right? You just don't report the next year, and that's when they find out. So this is a lag measure, and we're probably going to see this chart stay down for quite a bit longer.
And as an owner, trying to tune in and learn how to use real numbers and not emotion to make these decisions of what your future is and the direction you're going to go. It's easy to speculate and react when you want to take the approach of taking action that's planned. And it's easy to say, but it's hard to do.
So we always like to talk about the driver career journey, and it's just interesting to see how it goes over time. And so you start off, you go through driver school, you become a company driver. That's that first step. And then usually, if somebody wants to start their own business, they maybe join a lease purchase program. It's an easier barrier to entry, right? You low money down, but it's a high failure rate. Then you move on and you say, hey, I want to get my own truck. So you go out and buy your own truck. Maybe you like driving for that fleet. We call that a hired gun. You still like that safety net. Like Jay, working for Landstar, you get the cheaper insurance, fuel discounts, great freight network, things of that nature. The next step for some is that they want to go out and get their own operating authority. Like we saw in that freight boom, everybody went out and got their own authority and started booking their own freight. So we saw a huge migration from left to right in the really good era where people were going out, getting their own truck, getting their own authority. Over the last 2 years, we've seen the opposite. We've seen people go from the right to the left, where maybe you had your own authority and it wasn't working, you hooked onto a big carrier. They had better rates for a longer period of time. Some people sold their trucks and became company drivers. So we have seen a big movement in terms of where people are sitting and where they are in the spectrum.
It's very individual. I have associates, people I'm talking and working with in all those categories who are quite successful, even in this down market. And it's very individual in their ability, and then probably one of the most important thing is who's their customer, who are they going to work for, what kind of freight, what kind of equipment, and so on. So try not to judge the whole industry based on just an average or what we might hear at the coffee shop.
So that's just kind of setting the stage. We know trucking's tough. We've all known that in this room for a while. It's tough because of a lot of reasons, but we did add too much capacity. It's making it tough longer. But let's look at the data and see what happened in 2023, and then kind of talk about what's going to happen this year and what to expect and what you can do to hedge a tough market. So we do this the same way every year. We've been doing it 25 years. Essentially what we're looking at is industry trends on a year-over-year basis. So we took the end of 2023, and we're going to look at what it looked like compared to the end of 2022. That way we can see if we're going up, down, sideways, what's happening.
Yeah.
So very consistent data here that's very helpful. So we're going to start off looking at revenue. That's miles, revenue per mile, gross revenue, what happened on a year-over-year basis. So any of you that were in here last year, it was still tough. It was already tough last year. And so we talked about two main things that you can do to change your business in a tough market. Number one is you can create more revenue. You can take an extra load and you can earn more money towards your truck. And so at that time we said, hey, what does one more load a month do to your net income? You get 500 miles at $2 a mile, you gross $1,000, and you've already met your fixed costs. It's an extra load, so you've already hit those fixed cost numbers. So you don't have fixed costs, and then your variable costs are in there. One extra load a month is about $600 a month in profit, or $7,200 a year. So super important that in this market, that's the first thing you can do. And so what happened last year? It happened. It actually happened. It was a year late probably, but drivers did run about 6,000 miles more, about 7.5% more miles on a year-over-year basis. And what's interesting is if you look here in the bottom right, we kind of have it segmented by people on their own authority, dry van, refrigerated, and flat. Flatbed, any of you that are flatbedders know that rates are tough. It's been a really, really tough year in flatbed. But guess what? The ones that survived responded the most. And flatbedders are up 13.2% in mileage on a year-over-year basis, and they had to just to survive.
That's right. They found the market, they found the niche, they fostered their relationship with those customers, and they invested in that that's so key, invested in that relationship. And if you work that extra load, it can be like working an extra month of income. The other thing that happens, like you had there, you dilute those fixed costs, which is strange. Fixed costs are variable by time. So that's one of the things to kind of try to wrap your mind around.
So this is just miles over the last 21 years, but it's pretty incredible to see trends. And so if you look in 2007, we were in a good economy, and then the Great Recession hit in 2008. And so again, trucking got tough, and drivers responded. They responded in a big way. Same thing that happened in 2022. We saw miles fall off a cliff when freight was amazing, as you would expect. But drivers have responded over the last year, and miles are up at a considerable rate. And again, it's when times get tough, you have to keep working. You have to work harder. You have to buckle down. So it's
Work
good to
harder, work smarter, and working smarter could be the hardest thing to learn. Because you've got to change habits, and changing habits is very difficult for most of us. Ask my wife.
So here's just a 5-year kind of snapshot of miles on a 6-month basis. And you can see prior to the pandemic, owner-operators were averaging right at 100,000 miles for a pretty long time. And that was pretty consistent. But then, again, that pandemic freight hit, and rates were so good that we had clients saying we were running 3-4 days a week at most and then going home because they were making so much money. Well, that changed. And again, now we're on an upward trend. But this causes other issues, which we'll get to here in a second. So this is revenue per mile. We're down about 9.5% year over year in terms of true rate, down to about $1.93. Again, I have the rates broken down for different segments down here in the bottom right. So I would tell you, we're down 20 cents a mile. I would tell you 60 to 75% of that's probably the fuel surcharge. The cost of fuel's gone down since the last year, but the other percentage of it is true rate drop, where we've actually lost, true rates in the marketplace.
Yeah, and remember, these are average rates. So your goal, you have to decide, what is your goal over average? Where are your numbers currently versus average? So this can give you an idea where people are going to, if they're below, potential fail. But you can measure. You need to get your own numbers in line so you can measure it against these things.
So this year we did something different where we said, let's back out the fuel surcharge, right? Because that last chart, it didn't show us the cost of fuel baked into that. So what I did was that we took a very simple calculation for the fuel surcharge. I think it's the most common one used, is 6 miles to the gallon at a 125 basis. And we just took that fuel surcharge out. And so we saw rates, again, they plummeted in 2019, 2020. And then that pandemic freight, we saw it rise at a rate we've never seen before. And because of that, we added trucks, we added everything we could to capture that income, and then we saw it drop off. But what's interesting and what we're going to see as a trend line here is that we hit the bottom about last summer. If you see in 2023 on the very right, about June, July is when we hit the bottom, and we've actually slowly trickled up in terms of true rate over the last 6-9 months. So it doesn't feel like it at all, but we are starting to, again, see positive signs where we pretty much bottomed out last summer, and we're starting to see good stuff.
I'm seeing that with the owners that I work with privately is the trending. And they're also getting better at load planning and selecting and learning how to decline the unprofitable loads. And that's something to learn.
So, we constantly hear about, capacity leaving the market. We hear about trucking companies going under. We hear about people leaving the industry. We hear about owner-operators going out of business. All the tech money that came in during the boom cycle, it's kind of evaporated. So with all this capacity leaving, why haven't rates come up yet? Why is this still at the bottom? And there's a lot of reasons for it, but one of them is because we're running harder, as I kind of alluded to earlier. So this is busy, but the main points of this are, in the peak in 2022, we think there were about 375,000 owner-operators in the United States. Over the last 2 years, we've lost about 20% of that population. We think we're down to about 300,000. So there's no exact number out there, but we believe this is pretty darn close. So we take that 75,000 out, but guess what? They ran 8.25% more. They ran more miles. And so those miles have actually offset some of this capacity leaving in a big way. So we lost 75,000 ICs, but when we add in the extra miles, it's really only equivalent to losing 50,000 ICs because of that extra mileage that we've run. So that's just owner-operators. That's a very small portion of the driver pool. And if you look at company drivers too, there's probably about 2 million. Again, there's no exact number here. Let's say half those owner-operators that went out of business went back to being a company driver. But if they went up at the same rate at that 8.24%, when we factor in those extra miles, we're actually positive 130,000 drivers because we're running harder to try to make up for it. So while capacity is leaving, trucks are leaving, businesses are failing, the ones that are still surviving are running harder and keeping rates down because they're running harder and taking up more of that freight.
Right. The fleets know what we're talking about. They know how to run more to dilute those fixed costs and so on. And they are crunching those numbers by the hour, is my estimate, is my expectation.
So let's just say company drivers only did half of what owner-operators did. Bottom line is we're still up about 46,000, almost 50,000 IC trucks in terms of utilization. So because of these extra miles that are being run, we aren't losing capacity actually. We're staying pretty flat, which is why rates have stayed down longer than normal. So we always like to look, does it make sense to run on the spot market or does it make sense to run for a motor carrier? What's the difference? And so if you look at the list here, probably hard to see, especially if you're in the back, we think it costs nearly 50 cents more a mile to run on your own authority versus run on a motor carrier. Why? You have to get your own licenses, permits, you gotta do your own IFTA, you have insurance that is insanely expensive, especially those first couple years when you're getting started because they don't know your risk pool yet. You have to buy your own trailer, you have to book and collect all your own loads and all that fun stuff, but most importantly would be operational losses. When you're a one-man show, you have to sit there and you have a lot of wasted time. You have to wait for live loading, live unloading. It's a huge amount of time versus a drop and hook situation where you just back into a dock, unhook, and get on your way. It's a huge difference. So we think it's about 50 cents more a mile to run on your own versus at a motor carrier.
Also, it's harder for the single small operator to find that customer because customers, they have to manage their risk. If you break down, what happens to their freight? Where they have a fleet and the support, they've got a backup. They have someone else that can hook onto the trailer or transload the load to another trailer, another operator, and keep that freight moving. That is very valuable to the customer. They know that.
So let's look at it at a more micro view. This is the same data, but that line there is the break even. Does it make sense to run at a carrier, or does it make sense to go get your own authority and get your own freight? So during the pandemic, you can see we were far above that break even. We even peaked at $1.36. So on your own authority, at that time, you could make $1.36 more a mile to be out on your own versus the average motor carrier. That only cost you 50 cents to get there. So you're at a net profit of 86 cents a mile to go do that. And that's why everybody went and did it. I mean, who could blame them? But then it just fell off a cliff in early 2022. And we've just, again, been bouncing on the bottom. Right now, the difference is about 32 cents a mile. But it costs you 48 cents to get there. So, you know, I think right now would be a really tough time to start on your own.
It absolutely is. There's so many barriers. I think the insurance cost, actually, when I see the numbers from people, that's kind of low, the $12,000 to be honest. And, but the administration, how do you administrate a business from your truck? That is very difficult. And if you don't have that back office support from a fleet, from a service like, you know, whoever you use for financial help and bookkeeping and so on, whoever that is, you need back office support. If you need factoring, that's huge expense. And I don't know, it seemed like there would have been more cost from factoring.
Sure, yeah. So yeah, it's a tough proposition. Those that have survived and have good relationships in the spot market that are on their own authority, they have good relationships with their brokers, are doing just fine. But if you're gonna go out and play on the load boards right now, you're gonna really struggle. Yeah. So gross revenue, I don't put too much into this, but we are down about 2.6% on a year-over-year basis. What I want to point out though is in the bottom right here, flatbed, they ran 13% more miles just to break even on their revenue. That's how tough it was in that flatbed market.
Yeah.
So we looked at revenue, now let's look at costs, because costs are obviously a huge factor. So look at fixed and variable costs as well as total costs. Our fixed costs are things like our truck payments, our trailer payments, our permits, FHUT, and especially insurance in a tough insurance market. So this one really, really stuck out to me. This is probably the highest fixed cost jump we've ever seen. Fixed costs are up 7.8% or $4,000 on a year-over-year basis. That is a really tough pill to swallow in a difficult market.
I told Mike, I said, I'm kind of surprised this fixed cost is as low as it is. that indicates to me we have a lot of the people that don't have a large truck payment. But a lot of the new entrants, their truck payment's $1,000 plus a week. So you could almost double that for a new entrant into the business. So when you look at that, instead of having, say, $260 a day fixed cost, they can be pushing $520 a day fixed cost if they're not careful.
So fixed costs were up, the biggest we've ever seen at 8%. Variable costs down though, 9% on a year-over-year basis. Again, most of that's going to be fuel, so we won't spend a lot of time on that, but variable costs were down because of that. So total costs down 2.2%. About $125,000, almost $126,000 was the average cost in 2023 to run for an IC. So pretty high costs. So we talked earlier, there's two things you can do to really sway movement in a tough market. You can run more miles, you can create more revenue, or you can cut your costs. It's literally that simple. What's your biggest cost? Fuel. And so last year we talked about it. Hey, if you go from 6 miles to the gallon to 7 miles to the gallon on an average number of miles, you're going to save between $8,000 and $10,000. And every dollar you save, you have to put in your pocket. So that was one of the big things that we coached on and have been at ATBS for 2 years now is, create more revenue, cut your costs, especially your fuel, and we are seeing responses.
I see that as every penny you save, or if you gain a penny or lose, it's $1,000 a year difference, either way. I kind of broke it down to per 100,000.
Yep. So fuel costs cents per mile, we're down year over year 17%. That's again mostly because of the lowering cost of fuel, but it's good to see fuel costs down. So miles per gallon, this is over a long period of time. You can see there's a huge uptick in 2020, and that had to do with congestion. There was no congestion on the roadways because everybody was working from home, locked down. And so I've had many clients tell me that 2020 was the best year they've ever had in trucking because there was no congestion. They could just go, and they got better fuel mileage because of it. Then for the next 2 years, 2021, 2022, nobody cared about fuel. Rates were so good, just go get it, right? And that's what people did. But now we have to start caring, and in 2023, we have seen a steady uptick in fuel mileage, which is necessary, again, in a down market. So this is just looking at it from a different angle, but again, we are seeing steady increases in fuel mileage over the last year.
Another thing on your fuel costs, if you're an independent contractor or an owner-operator independent, there are so many different fuel programs. But if you're a contractor, in your contract with the company, if they have a fuel program, make sure there isn't an outside program where you could actually save more money. That happens more than you think. You have a right as an owner to buy your fuel where you want. You just have to provide the information to the IFTA system, and there's help out there. So if you can save 10 cents by going to a different fuel program, investigate that. And if you need help on that, ask questions, get a hold of us.
So this just breaks it down by each specific industry, but what's important is at the bottom, we're now over 7 miles to the gallon on average. And again, if you look at the second to the bottom, flatbed, who got hurt the most, made the biggest changes to survive. They went from 6 to 6.5 miles per gallon, and again, they needed to survive. So I don't normally show this one, but I kind of wanted to point it out this year. It's busy, but at the bottom here, it shows us revenue was down 9.4%. So we were down about $4,800 in revenue. But fuel was down 17.5%. So $6,800. In a normal marketplace, when revenue is down $4,800 and fuel's down $6,800, that means we would have made $2,000 more.
But are we? That's a tough question because people have to have enough, data in there. They have to have their real numbers to measure, and it varies so much from owner to owner. And getting that information in the quickest timeline to yourself and learning where is my money going and how can I save that? How can I take advantage of that difference?
Yeah, and the other big thing, right, is the fixed costs we talked about, up $4,000 on a year-over-year basis. So when things should have been good, the inflationary costs that finally caught up with us on truck payments, insurances, and things like that have made it even tougher in a down market. So this is just truck payments over time. It's really busy because it's 20-some years of data. What's interesting, though, is in 2021, 2022, it kind of flattened off there because you couldn't buy a truck. You couldn't find one. They weren't available, or they were so inflated on price that nobody in their right mind would have bought a truck at that time. Well, now that truck prices are going down, we're starting to see people upgrade their equipment, get newer trucks and things like that. The average truck payment we're seeing for our clients is now at $2,900 a month. So pretty steep truck prices, and that's not going to go down anytime soon. There's new CARB regulations coming out, which we all love, of course. But yeah, there's new technology coming out. The materials costs, the labor costs, the union costs at the plants, everything's going up, and that means truck prices are going to continue to go up.
The interest rate on financing, and I watch the financial markets a lot, and everybody's watching the Fed. They anticipate a drop in interest rates coming mid-year possibly. We got to wait.
So maintenance is concerning. It's flat on a year-over-year basis. And the reason that's concerning is because we went up 7.5% miles. And so in a normal time, if you go up 7.5% in miles, you should go up 7.5% in maintenance. That's just wear and tear. That didn't happen. There's two reasons. One is because probably newer equipment, right? If you get newer equipment, your maintenance costs are likely going to go down. But a big reason that we see here, and I'm going to fast forward a little quicker because I know we're running short on time, but we see deferred maintenance when times get tough. And that is the kiss of death. So it's just so important to look at. If we look at the Great Recession back in 2008, 2009, we saw maintenance fall off a cliff, and then coming out of it, it spiked. It's because people didn't have cash flow and were deferring their maintenance. And if you do that, that can lead to major mechanical failure and put you out of business.
Right.
So here we are again on the right side. Maintenance peaked, and now we're falling off a cliff. And it feels like, part of it again is newer equipment, but it feels like people are starting to defer their maintenance.
Investing in that, what would be the aftermarket, people call it a warranty, but equipment protection programs, that's like health insurance. It's your catastrophic health insurance for your truck. And you may pay $8,000 for a 3-year policy, but the average payout I get from Tim Ronan from NTP sends me the data, and they pay on average out somewhere between $5,000 and $11,000. It depends on the repair. They've paid as much as 80-some thousand for a repair, replacement engines and transmission on one truck.
Let's get to the fun part, net income. That's what we all want to know, what we all want to increase, and why we do this. So net income on a year-over-year basis for the average IC is down 2%, down to about $63,000. So this was down from the peak of almost $72,000 2 years ago. We've seen a huge, huge drop-off, nearly 10% in terms of net income since the peak. But it's encouraging because 6 months ago, this is year over year, 6 months ago, we were flat or even down a little bit lower. So that tells us, again, that we probably hit the bottom last summer, and we are starting to see those extra miles, that better fuel mileage, result in a better net income. And if you look at this line graph here on the bottom, again, we bottomed out in June, July of last year, and we've seen net income start to go up over the last 6-9 months for independent contractors.
Be aware of, if you're doing a W-2 paycheck, profit income combination, be aware of how that works out for you.
So this is net income over time. Again, very busy, but what's interesting is to look at the peaks and valleys. So again, in 2018, it was a good year. We saw it go up. 2019, 2020, a slight dip, and then it went through the roof to the highest we've ever seen it in 21, 2022. And again, we went down for 2 years, but if you look there on the very right, we started going up over the last 6 months. So it's really, really encouraging to see that the hard work that you all are putting in, the adjustments that you're making, are actually starting to pay off. And while it doesn't feel like it because times have been tough for so long, we are headed in the right direction for the first time in a while.
Right. Try to identify any savings, escrow, or whatever. Give it a name, give it a purpose. Don't just say, well, I've got X dollars in this account, in case of an emergency. Try to give that money a purpose, and that'll help you manage the expectations for the preventive maintenance or the anticipated loan payments and so on.
So we're proud of this for sure at ATBS. We do a lot to help our clients. We consult them. We look at monthly P&Ls. We set up budgets. We do things of that nature. And I'll tell you, if you use ATBS to its fullest extent, it really pays off. So we backed out our clients that have been with us over a year. The other averages were all of our clients. But if you've been with ATBS over a year, the income goes up considerably because they're utilizing the system, they're looking at their numbers, and they're making good choices. And if you look there, the middle third, our average client that's been with us a year is up to $85,000, which is really incredible. That's $20-some thousand higher than the average IC. And our top 10%, they went from $206,000 to $212,000 in terms of earnings. So there's some teams in there, but there's a lot of solos in there too. And it's just really good to see, again, that those top earners, the hardest workers, they're starting to see their income go up again for the first time in 2 years. So really encouraging information.
And I support these numbers with the individual where I examine and help them audit their numbers and that. Not everyone's losing money, of course, but I have several people I know that are profit, and if they're doing payroll plus profit, 100,000 plus as a single driver. They have their niche, they have their market, they have their customer they establish. There are ways to do this, but it just doesn't happen by itself.
That's right. So this is what ICs have to do in order to earn what income. So back when we started doing this 21 years ago, the average IC was running 140,000 miles a year to make $47,000. That's a tough life. That's a lot of miles. That's a lot of time away from home. We peaked at about 85,000 miles and 72,000 net income. We're now at about 91,000 miles and 63,000 net. So again, it's down, and that's really, really tough to swallow in an inflationary time like we're in. I mean, the cost of groceries, the cost of everything has gone up, but our income's gone down. And so that's why we have to continue to make adjustments. But again, I look at those last 6 months, and we've started on an upward trajectory again for the first time in 2 years.
Yeah, exactly. And you have to think about the type of contract you have and how that pays, if it's percentage, if it's per mile. All these things are influencers on your decision about what you do, how many miles, and so on. My theory is less can be more. You just have to understand what you're doing in your market with your customers.
So this is really busy, but what it really shows is miles have increased at the very top on a year-over-year basis. And on the bottom, because of the increased miles, we are seeing net income go up on a year-over-year basis again. So that extra hard work is really, really paying off. It shows it in the law of averages, and it just shows it with the people that are making those adjustments. Their attitude changes, everything about it changes when you start to make adjustments and set goals. And when you hit those goals, it's really rewarding, and it pays off on your bank account as well.
Yeah, build a plan. I'm not going to ask, who has a business plan. You have one probably in your head. It's often hard to put it on paper. There are ways, there's tools to help you do that. You just got to start asking. We can help guide you into those, tools.
So this is an incredible amount of information, a lot of data. What does it all mean? So what I'll tell you is revenue per mile has flattened out everywhere. Once you back out the fuel surcharge, it's flat. It's not going up, it's not going down, it's very flat. When you talk to carriers, when you look at the spot market, we've just been flat for a year. But what does that mean? I mean, we see a lot of turnover right now. We see a lot of bouncing around, and it's not great anywhere. And so the grass is not greener on the other side most of the time right now. And I think that's really important because it costs anywhere between $10,000 and $15,000 to make a jump from one carrier to another. So it's a big deal. But probably the biggest part about this is knowing your costs. We talked about it earlier. Your fixed costs are up 8% year over year, but your variable costs are down 9% year over year. Do you know your current fixed cost per day? Do you know your variable cost per mile? I know Jay does. You don't get to drive a year without getting there. But if you don't know those numbers, you need to reassess because things are changing rapidly. And if you don't know that, it's impossible to choose the right load.
Right. And if you know your per diem days, that's important, but are you efficient with your per diem days? What is the lost opportunity potential and what can you take advantage of? And don't overcommit because that can get us into trouble, but building that economic and efficiency, you as a small owner, the quick decision making, you have the advantage there versus the fleet.
Yeah, so it's just so important to do a new budget, to understand your fixed cost per day, to understand your variable cost per mile. You can plug those into a quick calculator and determine how profitable a load's going to be right away. And then you have to map it out. You have to keep a scorecard, you have to have a profit and loss statement, and you have to keep watching it because your variable costs, your fixed costs, everything do change over time. And so if you don't make adjustments consistently, you fall behind. Every business owner has to make adjustments all the time. You can't do the same thing over and over again, or you're gonna lose. So, miles have gone up. I think that's gonna continue up this year. We're at 91,000, 8% year over year, but that's gonna continue to go up. It has to. Fuel mileage has really improved, and that needs to continue to improve. The best owner-operators, as we saw, they've done both. They ran more miles, and they got better fuel mileage, and their net income has accordingly gone up this year, which is great to see. But working hard right now. I mean, every business in the country has to dig in and work harder. When times get tough, you got to keep working harder. As my boss, who's in the back of the room, always says, tough times don't last, tough people do.
Yeah.
So you just got to work hard when times get tough, and you'll make it.
Yeah. You know, be aware of your brand name, your emotional biases, as I call it, because that'll prevent you from changing and adjusting. That is really important for you psychologically to break through that, and that's not easy to do. You've probably all seen this. Somebody will say, what kind of tires should I buy? Oh my gosh, that's one of the hottest things, and you'll see them name their brand names of tires, but they will never say why or what it costs per 30-second to run, how many miles, and what's the cost per 30-second to run that tire. You got to buy value. You got to get the most out of every investment that you put in, whether it's fuel, the tire, the maintenance, the prevention, whatever it is.
So that's all we've got for today. What questions do you all have?
You talked about the importance of putting together a business plan. Like, what are the most important factors to consider when putting that together?
It's a really good question. With my private coaching, what I learned was if we try to make it too complicated, people don't do it to begin with. So I just established what I call a profile, where it's pretty much, you know, short answers to things like, do you have a tax preparer? What's your business structure? You know, financing and so on. Do you own a truck? Are you leasing a truck? And just grow on that. And then at the bottom, it's like, what's next? What questions, and so on, to try to start filling in. So when you do it, my experience is to build a business plan, it's almost like you want to have a conversation with someone versus this complicated document. Because what happens, if you do a big complicated document and you actually do it, where does it go? It goes in a file folder somewhere in a desk drawer. You don't use it. You want tools that are interactive, that you can relate to, that bring value, and then you can adjust those, and you have to keep revisiting it.
Are there any other questions?
Yes. Well, you had the graphs up where you're talking about, you know, the freight, when we were talking about, you know, the freight rate.
Mm-hmm.
It seemed to me that before the pandemic, we were like down here, and then the pandemic happened, and we're, you know, through the clouds. But was it an illusion that we're at a level where we're higher than we were before the pandemic?
No, we are higher than we were before the pandemic, about 30 to 35 cents higher than we were prior to the pandemic. But again, that's going to go back to the cost factor, where our fixed costs, our insurances, our truck payments, and things like that have gone up to the point where that's now the new floor. So definitely not an illusion. We are higher, but the increased costs that you're incurring have completely offset that higher rate that you see on paper.
The inflationary effect, and the thing to remember is when our income goes up, suppliers raise their prices, don't they? But when it drops, there is a lag. They won't lower their prices until they can't sell their products, and then it starts to reach the equilibrium, and then it's, you know, it's this game like this.
Yeah, the other question is whatever kind of, you know, program you're using to track your numbers.
Yeah, I know at ATBS we recently implemented our new hub, and it's an app and it's an online portal, but we do data entry in real time. So if you get a weekly statement, if you get a factoring statement, whatever your business is, you just take a picture of it on your phone, and then we'll have it entered in a day or two where you can track it in real time. So
I coach the owners to do weekly P&L and then run that average through the year, and they'll see that weekly P&L profit move, And that also is a psychological help to avoid overspending. So instead of saying, wow, I got $5,000 last week, I can go out and spend $4,000. $4,000 is already going to pay bills. You have $1,000 to spend. And that's very important. And the other thing that happens with contractors or even in when you have automatic payments or deductions out of settlements and so on, you have to be very careful to recognize the money's coming out. A lot of owners struggle with recognizing how much they're paying through their contracts as deductions. So you need to, every week, you need to really touch that number, because you never write a check, you never pay the cash, you don't feel the pain of that payment, you just assume you're gonna be fine, so.
I've actually got a couple of questions. One, I hear you talking about the rising costs and the rising floor, where it's up 35 cents for the new floor, but in comparison to the new floor, are you thinking that rates, based on the other gentleman's question, are still outpacing it so that we're still better, or that our rates are less than the 35-cent gap?
I'll tell you that net income is pretty much exactly the same as it was prior
it looks
to the
flat.
pandemic, so it's flat.
So it looks flat. Secondly, I mean, when you're talking about reducing your fixed costs and your overall costs, I haven't heard a single person all weekend talk about the fact that most owner-operators, whether you're signed on to Covenant, Landstar, Warner, whoever, or you're the trailblazer, should be counting in their fixed costs a certain amount of their revenue per week to go into escrow for preventative maintenance. Because if you get ahead of the maintenance and maintain it, it's a hell of a lot cheaper than fixing it on the backside.
Oh, yeah.
The other thing is working the tax code. I haven't heard anybody talking about reducing their overhead by working the tax code. As far as if you're working for a big fleet, or if you're looking at those big fleets, they're calculating exactly how many gallons they need to buy in this state, that state, so they're not paying IFTA. They're getting returns. Most owner-operators are paying that per quarter, and they're not thinking about it till the end of the quarter, and then they get a $300,000, $800,000 IFTA bill that they're not prepared for. I haven't paid IFTA in over 15 years. I get a return every quarter. But I haven't heard anybody talking about working it the way the big companies do from an owner-op standpoint. If you want to compete with them, you need to think like them.
Yeah, that's a
We got to
great,
get it wrapped up, and there is material about those very things in the Partners in Business book.
that's,
Yeah, we're gonna post those for sure in the report that comes from this coming Monday. So keep an eye out. That'll be at overdriveonline.com. And I want to thank everybody for coming. Download the book. Really congratulations to Mr. Jay Hosty, and thank you guys for recognizing him.
There's our
And
contacts.
we'll be around. Find us outside.